Let's talk about the backdrop for investing in small caps right now. We have a strong dollar, weak oil that cratered last year. GDP growth has been kind of anemic, economic data so-so, and interest rates. The world is kind of captive to when the Fed is going to raise them. How would you characterize the opportunity set right now?
I think that the current economic backdrop is supportive of small caps continuing to outperform. The economic growth maybe isn't as great as most people would like, but it's sufficient enough for companies to continue to earn nice profits. With interest rates projected to go up more slowly, more likely, I think it just it gives investors time to adjust to a rising rate environment.
Yeah, we've been hearing so long, we thought the Fed was going to have a June liftoff, and now now that they've said they're data dependent, it looks like we might not be able to meet that hurdle for June or even July, to your point.
And presumably one of the reasons for raising interest rates going forward is because the economy is doing well, and if the economy is doing well, again, that sets a favorable backdrop for corporate profitability. I think one of the issues that investors are going to have to understand, though, is that reset the expectations for returns. Obviously, since the market bottomed in 2009, small caps in the market in general have compounded at well above normal rates of return, and so we're more likely to see more normalized returns going forward, whatever normal might be. But if investors are expecting high double-digit type returns again, it's probably unlikely. It's more probably going to be somewhere in the high single digits to low double digits on a compounded basis over the next few years.
So a resetting of expectations.
Right.
Yeah.
Yeah, I think, again, it just goes back to, if you look at the start of this chart, going back to 2009, you have to look at what preceded it. And what preceded it was a pretty dramatic drop from mid-07 through March of 2009. And so hopefully that isn't going to be repeated. We won't see another drop of that magnitude. So the fact, what's driven the market the last 5+ years has been a recovery off the bottom. It's been, obviously a growth coming out of an economic recession, and in the subsequent revenue growth, margin expansion, and multiple expansion within the market. So a lot of what's driven the market in the last 5 years is unlikely to repeat going forward. So it really comes back to, at this point, making sure that you understand what the risk parameters are for the market overall, as well as the individual companies in your portfolio.
Yeah, well, that's a really interesting point. Do you feel, though, that the small caps are more insulated from a risk perspective than, say, their large cap or mid cap peers from these macro headwinds?
No, I don't think they're necessarily insulated, but I think it comes back to the point, the U.S., while the economy may not be doing as well as we would like, I think is doing better than most economies around the world. So it's the overused term, it's a bit of a safe haven. So I think with 80% of revenues for small caps derived from domestic sources approximately, it just provides a decent backdrop for companies to continue to perform. The wild card will be what is the investor appetite for risk, and that can be impacted by a lot of things. The pace of interest rate increases, it can be impacted by geopolitical events and just an overall perception of risk around the world. So obviously there's no guarantees going forward, but the backdrop is favorable, and so long as we don't have a dramatic change in interest rates, we don't have an exogenous shock to the system, then I think it does set up pretty well. Okay,
so set up pretty well unless we see a steep rise in interest rates, which seems to be unlikely at this point, or some black swan
And with
event.
that reset of expectations, that we're probably not going to be going up at a 20-25% rate like we did, at the beginning part of the recovery.
Okay, so again, about resetting expectations. Yeah, and even if rates rise, they're still on a relative basis very low for borrowers.
Right, and in a rising rate environment, it may change the composition of what drives the market as well, because again, a rising rate environment raises the cost of capital for a variety of different industries, and so a lot of these growth industries that need capital to grow, they'll be facing a higher cost of capital, which will, for some companies, will impact their profitability or their profit growth. So the composition of what drives the market will change in this rising rate environment, and maybe we'll get a reversal of that Russell value versus Russell growth, which he's right. The long term clearly shows that values outperform growth over the long term, and the recent past has been an aberration, partly fueled by the abnormally low interest rates that the Fed has created.
So you think we could see a reversal once the Fed raises rates?
Between the growth and the value segments of the market, absolutely. I mean, I think what's driven the market the last 18 months or so has really been, again, that willingness to take risk at a certain level. And we all know biotechnology has been a big driver of the small cap segment. It's up several 100% over the past few years. Part of that is because of the availability of capital, the availability to raise equity, and it's been a big headwind for a lot of active managers out there. You've also seen, in the chase for yield, REITs perform very well, and REIT yields and cap rates going to levels that suggest they're richly valued. Utilities had a real strong year last year. So those are the kind of things that have been driving the market. And as we were saying earlier, if interest rates do start to rise and go at a modest pace, as we've said, then I think that's one of the things that really could change the tenor of the market. And so I think investors just need to be aware of the risk of chasing what has been working, the Russell growth, what's been, chasing the biotechnology or other areas. Doesn't mean that they're going to collapse and they're going to fall out of bed, but if they stop going up at the pace they've been going up, I think that, again, changes the tenor of the market.
And do you think, you mentioned the risk before, people's expanded appetite for risk, do you think that was largely driven by a lack of yield or chasing yield?
I think that is part of it. I think that, with yields on risk-free investments being where they are, investors are really, really struggling to try to get some kind of income. And so you've seen, yield-oriented securities really perform well. And that's fine. But can you continue to grow the dividend at the rate you were? And if all of a sudden the competition for those yield-oriented investors change because risk-free rates are going up, then it would be natural to see some unwinding of that. Again, doesn't mean that you need to call for a bear market in yield-oriented investments, but if they just stop going up at the pace they've been going up, then again, it changes the market environment.
So a little bit of a change, especially with REITs and utilities.
Right.
I mean, buying 8% of a daily volume of a stock is enormous. So that's an interesting point. Are you guys seeing that as well?
Yeah, I mean, I think, trading liquidity has always been an issue in the small and micro cap segment of the market. We focus more on the liquid side. Same thing just from a risk control perspective. We're trying to make sure we can build a position and exit a position if we need to. So, it's never easy, but I don't think it's a constraint on building a nice portfolio, and I don't think it's a constraint on generating good returns. If you're focused on micro cap, you learn how to deal with it, and so again, I don't see it as an issue. But what's the root cause of it? I'm not exactly sure, but I think the markets are changing. Mentioned the rise of the ETFs before. That's clearly having an impact, on those segments where there are ETFs, and then the dark pools, the algorithmic trading, and everything else in between. So the nature of the market has just changed. But you deal with it. You identify good companies that can create value. You buy them at the right price, and if you hold them for a long period of time, you can still make money. So trading liquidity shouldn't be an issue for long-term investors. Absolutely.
Sector-wise, what are you seeing, Jack?
Well, like you mentioned before, I mean, with the proliferation of broadband, I mean, obviously with all the connected devices, whether they be consumer or whether they be enterprise, demand for broadband just continues to go up. So you don't necessarily need to own the broadband service providers, but the companies that help wire the nation, if you will. So there's situations like that. And I do think energy's obviously taken it on the chin here in the last 6 months or so. But I think there's still a longer-term opportunity within the energy sector with the development of the shale reserves and companies that can help on that. Does that mean going out and buying them today? Not sure about that, but there's clearly opportunities there. So from a secular basis, we try to stay focused on the company's specific fundamentals as opposed to trying to identify a trend and then go and building a portfolio. So we look at these things, but we really start with the company and try to factor in the risk associated, whether it's a secular story or a cyclical story, and so, we're finding opportunities across the board. The only thing we really avoid is binary situations where if you're right, but you're wrong, you're going to get wiped out.
Can you give an example of that?
Well, I mean, biotechnology is the best example, but it can also be an energy company that has a one opportunity to discover oil or gas. And if they're unsuccessful, there's no company behind it. It can be single product companies. It can be a variety of situations. And so it really just comes down to that risk reward. And I think the idea is to keep an open mind, be sector agnostic, be industry agnostic, be business model agnostic, really trying to identify good companies that can create shareholder value. And if they have a tailwind of a secular story like broadband or like any of the other number of secular opportunities out there, then that's great. But it needs to be able to stand on its own 2 feet first.
Right. So what would, for instance, E&P be an example of something that's not so binary, or a different type of service provider within? You mentioned
Yeah, I mean,
the energy
revolution with the advent and development of the shale reserves in the U.S., it's when oil was $100 a barrel, a lot of these areas were economic. Well, now that number's been reset, that changes. There's still opportunities within the shale, but it's not as broad as it once was. So then you need to focus on the right areas that are more economic at lower prices, and which companies are going to help lower the cost development curve for the energy industry. Several years ago there was a lot of talk about peak oil. Well, peak oil is dependent upon the price of the commodity and the technology that's developed to help unlock the reserves that are in the ground. So the point being is that I think there's even though oil may have reset down to a level, which I'm not sure where it's going to finally level out, there's still going to be opportunity. You just need to be able to dig in, do the homework, as was mentioned earlier, and identify good companies. And if you get upside because oil moves back to the $100 level, that's great, but you need to be able to make a case for it in the current environment and not depend on that to really drive your return. I think that's one of the exciting things about small cap is that there's always new opportunities to look at, and you don't have to participate in the hot IPOs where you're probably not going to get much of an allocation anyways. So I wouldn't describe it as a strategy of ours, but it's something that you look at because you're always looking for things that are being, what we describe as being beaten up for the wrong reason. Maybe it's for a short-term, legitimate reason, but does it change the long-term outlook? If you do your homework and you identify that it's not, that's a great investment opportunity. So rather than be frustrated, you say, this is great. This is lots of opportunity out there. And so when people debate about the levels of the market and where we're going, I say, well, again, I'm not sure if I can call the direction of the market overall, but what I do know is that there are opportunities out there to identify individual companies. Maybe they're broken IPOs, maybe they're well-run companies that have stubbed their toe, or maybe they're companies that have just had a slow, turnaround. And again, that's what makes the small cap market very exciting. It's just very dynamic.
Very dynamic, absolutely. And with this cycle that we're, looking forward to, looking ahead, do you think that this is a point in the market that will favor the activist investor with small caps?
Well, active manager, activists.
Active manager.
Activists will create their own opportunities, but active management, I think, we are setting up for a pretty nice environment. Again, it's been a challenging market for the last few years for active management because for a lot of the reasons we've talked about with the, the high correlations among the individual securities, with the real focus on some of these higher risk areas. Or higher beta areas, and as we said before, coming off of that low in 2009 through currently, where the market's been compounding at 15, 16, 17% a year, that's unlikely to be repeated. Doesn't mean you have to call for a bear market. You just say if we stop going up at the rate we were going up before, the market broadens out a little bit, and you get a rotation of what's driving the market. I think it makes it creates a favorable backdrop for active management. And the key to active management for us is being long-term oriented, and staying focused on, is the company creating value? And we don't necessarily care if the market's not rewarding you for it right now, but if you create value and you pay the right price, the market will eventually catch up to you. So I think that's the kind of world that will again, it's never easy. Everybody here knows it doesn't mean that it's easy, but active management becomes, it becomes more in favor, if you will.
Absolutely, that makes sense.
And I think what it does is it points to the importance of profitability. I mean, unprofitable companies can go up in the short term, but they can't go up forever. It's just mathematically impossible. So the fact that the S&P 600 has that profit requirement speaks to the benefits of really being a good long-term fundamental investor, where companies that can grow their profits and create value for shareholders. So, you'll have periods of time where it reverses, where unprofitable companies do well, but it's just not sustainable. You either have to turn a profit, or you're going to go out of business.
Compensate it for the risk, and with the returns, you are. So, your final takeaways, Jack.
Well, again, I mean, obviously biased like everybody here, but I think it is a great asset class. I think it's because of the inefficiency, whether it be from a trading liquidity perspective, whether it be from a Wall Street coverage perspective, whether it be from an access to management perspective. I think there's opportunity to identify underappreciated companies, and there's an opportunity to generate excess alpha relative to the benchmark, and that's what gets you excited every day. Is that there's a real chance here that you can go out and identify that new undiscovered company that's going to go up dramatically over the course of 3, 4, 5, 6, 7 years or longer, and so. Cycles will come, cycles will go. Investor enthusiasm for small cap will ebb and flow, but I think the long-term data will proves out that this is an area that you can generate above-average returns as an asset class, and it's an area where skilled active managers can add alpha above and beyond that. So that's what gets us up every day, is to try to do that.
Absolutely, and investors are always looking for alpha. So